Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, June the 11th. My name is Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic to geopolitical and market analysis. Well, I do the same thing in these daily market commentaries, but I layer on top of it some option strategies that I find to implement into our portfolio in order to lower our overall cost basis on some trades, which I'll talk about today, and increase that overall yield in our portfolio. Please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on with some economic data. And we've got a couple of things, nothing really across the pond, but here in the United States, we got core PPI, which is Producer Price Index. Core PPI strips out food and energy. It's one of the more volatile aspects of that, as we can see here with crude oil coming off by about $4 today. We talked about the build causing that and the overall markets, which we'll get to here in just a moment. But core PPI came in line with expectations at negative 0.1%. So that being said, overall markets without food and energy remained kind of like deflationary, if you will. We saw PPI, Producer Price Index, adding back in that food and energy. Well, it moved up to 0.4%, expected to be 0.1%. Now, that's not unexpected, as we can see this rise in the crude oil right here. Well, that's part of that food and energy. It goes higher, that's going to drive prices higher, right? And the other side of the coin was the food aspect of this data point. Well, we've seen supply chain disruptions, and that has caused some products like meats to move a little bit higher. So the food and energy aspect of that, really not a surprise that we've seen that move higher in the core PPI now, or in the regular PPI, adding back in that food and energy. The idea here is, if we see inflation, they're probably going to pass it on to the consumer, and usually inflation is a product of more buyers, people wanting to buy and driving prices higher, right? Well, that's usually a good sign, because that means there's spending going on and things of that nature. So I think that data point is a little bit misleading. It is a very hindsight number right now with what we've seen with Powell yesterday, which I'll talk about here in a second, really kind of throwing a wet blanket on the overall markets. We also got natural gas storages at, in line with expectations at 93 billion cubic feet. Unemployment claims came in slightly higher at, slightly lower at 1,542,000, expected to be 1,550,000. Not really going to make a dent in the overall market there. Now, crude oil coming off yesterday, we saw the market build in crude oil, and I said it should show some weakness there. I think it's exacerbated by what we're seeing here in the overall markets. Yesterday, we had Jerome Powell speaking, and not really adding any love to the overall markets. As a matter of fact, talking about them being a little bit overdone for the most part. And we are starting to see the markets come off of these all-time highs. Now, if you've been watching the daily market commentaries, you guys, I have been talking about this. Newer traders are coming into the markets. TD Ameritrade has said that education viewers or educational video views on their platform have like increased by 60% or something like that. So a lot of new investors coming into the markets. That usually causes the overall markets to rally, because newer investors are usually buy side. Another thing that we're seeing is a lot of these penny stocks. You've seen me doing some of these penny stocks as well recently. I've been throwing some of those into my IRA. Now, the reason why I'm doing that is because I think that those are more long-term. I'm not trying to just flip these necessarily. I thought that there was some value in some stocks at that low level, and I wanted to get into those for the long haul. But that being said, there is a lot of new investors with lower commission costs, or zero commission costs for the most part, on buying stocks. That's caused some people to come into the markets and start taking advantage of this. And think about it, you guys. It's so easy to go and buy a stock these days that newer traders are relishing that whole aspect, especially if you even look at like Robinhood and their the amount of people that have signed up there is just astronomical. So a lot of those guys buy side, that's been driving the market. People believing that the Fed is really kind of supporting this market. Well, they basically yesterday said, no, we're not going to support it. And that really caused the weakness today, and it just is kind of unabated to the downside. Moving on to gold now, it's not surprising to see gold start to make that move higher here as well, up $21. And yesterday on that FOMC started making that move. Bonds up almost 2 points on the day, coming back into that area where I've talked about. It's just slightly shy of that. I do expect it to start moving back towards that 180 handle as we go on, even into through next week. You can see we've got that volume node right there around that 180. I expect that to start getting built out as well. So when we're talking about that 180 handle, not a very good line there. So let's just draw this one, kind of looking at around this 180 handle there. That's where I think we're going to see that start to build out. Why? Because we are seeing this volume node start to build up here. Okay, so I think that that's where we are going to go back to. Yes, we do have a point of control right down here. Point of control is way down there, but that is so behind us at this point. I think that we're going to see this market point of control start to move a little bit higher to the 180 handle, because people are starting to price in that higher interest rates were in the future, and we're starting to see, as these economies are opening up in different states, these coronaviruses are starting to spike. Now, I'm down in Arizona, and people are a little bit flippant about their protection on masks and stuff like that. They're walking into places, even though they say it's a requirement, people aren't wearing the masks necessarily, okay? So we are starting to see that spike happen down here, and I think that when we start to see other states start to open up, those coronaviruses could spike. Now, we are also seeing 100-degree temperatures down here, so I don't know if this whole, heat and lack of humidity is going to, kill off this virus. So that's something to keep in mind as well. All right, so moving over to the VIX, you can see here back into the 30s, just a big, huge move today. 7.5 points on the day, and moving above the 50-day moving average there, but back into the 30s with the VIX, and that's because right here is what I'm talking about. Down 5% in the Dow Jones Industrial Average, almost 1350 down on the day. The market really coming off and away from that point of control, testing the value area low as well. When we're talking about value areas, we are talking about the market having about 70% in and around that area. That's what we're seeing. Markets starting to dump out. We could have seen these weaker hands, which is going to be those newer traders that I've talked about for so long. Newer traders come in, they're considered the weaker hands. They start seeing these things go against them, and they are one of the first to start dumping. So that's a good thing if you're a newer trader, but it's also going to be exacerbated with the people that are saying that all these stocks are overvalued, which, you've heard me talking about it. You need to go into those stocks that are going to be in and around that home theater or the home office, and that will probably do much better. I'm going to hold on to some of those. I have basically dumped out of all my travel and leisure, and I'll get to that here in a moment, but I want to get away from those. Market is coming off. I started dumping off the bat this morning. Don't know why that did that. Here we go with the NASDAQ testing the 9-day simple moving average. That's off by almost 300 points. A settlement below that. Remember, short-term bearishness. You go below, we see some short-term bearishness there. We have gotten the crossover, which is a long-term bull trend, but I don't think that we're going to go down and test those lows. I just think that we've seen what the economical impact of completely shutting down the economy is, and I think that they may limit how much they open up, but I think that the opening up is kind of a sure thing. They're just going to require masks, social distancing, and things of that nature. So I do believe we might see a correction here, or we are going to probably see a correction here. We could see the NASDAQ, after testing that or making that new all-time high settlement yesterday above 10,000, just a crazy rally as we've seen from that bottom. I think 9,400 is a point that we should be keeping an eye on for a correction to come back down for in the NASDAQ. Remember, they've been ones leading the way. They have seen the biggest gains. So with some of these weaker hands, even the newer trader is probably knows or believes they know more about tech than anything else out there, like Caterpillar or Deere or something like that. They're probably going into these types of stocks. As a matter of fact, they were the ones kind of pushing those travel and leisure a little bit higher. It was said that there was a lot more of the newer traders going into that. It was new money, if you will. So that was driving those prices much higher. Now, I think that we're seeing that buying ebb a little bit. That's where the people that the Wall Street guys have been shorting this or calling for that pullback are really starting to push this market back down. E-mini S&Ps near the lows of the day, off about 135 points on the day here, coming right back down to that point of control, which is what I just talked about yesterday. And I bought some puts in the E-mini S&Ps for this correction in case it were to happen, to add some protection to my overall portfolio. I've talked about that time and time again as well, right? We can't just be overall delta long. And I was saying, I'm feeling a little uncomfortable. I'm so delta long. Yes, my portfolio is knocking it out of the park right now, but we have to stay mechanical. We have to know that we need to kind of take some money and put on some insurance every once in a while when we start getting that gut feeling that, hey man, this is almost too good to be true, which is what I've been saying in this. And that's why we do the covered calls as well. We lower our overall cost basis despite the fact that we are in a bull market rally. And that's why I've been doing that as well, trying to teach you guys how we stay mechanical in this portfolio, even in good times, because there's always a point where we could see that type of some type of correction going on. And then if that happens, when you get out, you're actually, pretty happy. Despite the fact that you might have lost money on the stock, well, you made all this money on the covered calls and staying mechanical on it, lowered your overall cost basis, and ultimately find out, hey, I didn't do so bad on that trade. All right, here we have E-mini S&Ps. You can see basically as soon as we got Powell speaking, boom, market just free fell. All right, and we have not really seen any type of buying other than right on the open. We got a bit of a bounce there, and that was an opportunity to get out of some of these stocks. That's exactly when I was starting to dump. As soon as that bell rang, I had somebody like blowing me up that about his portfolio and what it was looking like, and I'm like, dude, I'm way too busy clicking and chasing and trying to get out of this stuff. So it was a busy morning trading for me anyway. All right, American Airlines is one of those that I decided to dump. This was over in my IRA, and if you guys remember, I went out and I bought AAL basically on March 12th. So March 12th, if we come back here, right around in here, I bought this for $15.02. Got long on there. I decided to go in. We saw this market start to correct, go down and close to $8, right? But during that time, what I did is I went in and sold the July 30 calls in there for $1.45. That was my covered call strategy, right? So I collected $1.45 there, and then I rolled that out. I let those expire worthless, and then I added some June off that. I looked at the July. I just did this, as a matter of fact, 5 days ago or something like that. I started out doing the June and tried to sell them for 145, but then if you guys remember when I talked about this in that daily market commentary, I said, hey, those July didn't see the volume or the volatility spike that we saw over here, right? This is probably right around that 5th. I got that volatility spike. Well, that volatility spike actually was front loaded into the July. So, into the June. So for that same 30 strike, instead of getting $1.45, I went into the June and sold those same 30 calls for 90 cents. So it seems like, yeah, I missed out on maybe 50 cents there, but also days to expiration. You got to remember, I still had that July I could have played with. At the end of the day, I ended up covering those today for 4 cents. So I collected another 86 cents for that. I sold out of my stock at $15.07. So I made 5 cents on the stock, right? Well, no, that to me would be a scratch. But the fact of the matter is I did make 86 cents on the trade on the covered calls, lowered my overall cost basis. So I made almost $1, right? That's, as far as I'm concerned, pretty good. I'll take that any day of the week. Yes, you guys could say, well, why didn't you get out here? Well, the market was rallying. People were opening up, and I was wanting to stay with it. I told you I was happy to get out at 30 if I could. That didn't ever get up there, but that was kind of where, to me, it was just way overdone to the upside at 30. It's probably overdone to 20 with American Airlines anyway, because remember, American Airlines, out of all of them, whether it's Delta, Southwest, every time I think of the Southwest LUV, it makes me want to say Las Vegas Sands. I don't know why, but Southwest Airlines, all of those other Delta, American Airlines is the one carrying the heaviest debt load, which could hurt them the most. At the end of the day, scratch on my trade in American Airlines, but I did make money on doing the covered calls because I lowered my overall cost basis. That's how we stay mechanical with that. Now, if we go over to Delta, this has just been a garbage fest for the most part. As a matter of fact, I started implementing some synthetic longs back in January, and that was basically during the old, when I was doing a webinar there. So I added this. According to that webinar, it was pretty bullish. That was well before we started seeing this coronavirus stuff. So I had gone into the June way back in January. So I had plenty of time to be right. Well, obviously, nobody really knew coronavirus was around the corner. So I'm synthetically long on these at 63. All right. That's where I basically got my synthetic longs on, doing the June 60 calls with the $3, 60. I got long at 60 because I ended up doing that for a credit. So let's just call it 60. Overall, then the market started coming off. I sold some 63 calls in there, doing the covered calls, right? Ended up buying those back for 7 cents. So it lowered my overall cost basis by, let's just call it 33 cents there. Ended up, market started coming back down. We saw what happened coming up very shortly here, because now I'm coming into February and sold the March 62 and a half calls. After I covered those 63 calls, sold the March 62 and a half calls for 46 cents, bought those back for 7 cents. So I made another 39 cents. So right now we're kind of looking at around 70 cents. Let's call it 70, 71 cents. Then did some dollar cost averaging trades in there. Sold the 45 puts in there for 70 cents. Now, obviously, market is much lower than where we are there. Market coming off again, got those put to me. Ended up selling some more 60 calls in there for 52 cents. Rolled those out in time and collected another 45 cents, rolling those into the June and collecting another credit So kind of lost track already where I'm at, but it's just about, let's call it $1.50 in and around there. You guys can do the math at home. Then market really coming off. Sold some 39 calls in there. Let those expire worthless for 96 cents. So I'm right around $2. Ultimately, I covered these today right in and around here at $28 and synthetically at $28.50. That was off that open because I did the the synthetic long got out of that. Also didn't want to get put those 60 get put the stock at 60 because I still have on the synthetic long and then the stock on top of it. So I sold out of everything right there at around $28.50. So I'm out. That was an overall loss on the trade. Pretty bad one, to be quite honest. But in the meantime, I did lower my overall cost basis by $2.50. It's a small win there, but at the end of the day, I'm happy about lowering the overall cost basis on it because I was staying mechanical with that. IBM, there's nothing to say here other than I just dumped out of these today on the pullback. It was something where the market just hates IBM, and I was wanting to get into this for the longest time and just picked bad timing on this. I had done the August, bought the 140 calls based on the webinar I did just last Thursday. I probably should have done them on Wednesday, but today, as you can see, that market just falling out of bed. I bought those for $3.40. I sold out of them for $1.44. So another loss there. Trying to trim back portfolio on stocks that I'm just not loving, and I know that the overall Wall Street hates IBM, so I decided to get out of those. And then finally, what was the other one that I dumped out of? Disney. All right, people are signing petitions to get out of or to not allow Disney to open up. All right, so that is I'm out. Plus travel and leisure. Like I said, I wanted to get out of all travel and leisure. This is a bit of a mouthful here because of how much I have tried to stay mechanical with this whole trade and lowering the overall cost basis. If you guys remember back again in in December. So yes, it was on the synthetic long. Sorry, I did do the synthetic long in Disney back in December, and I was long at 148 in the synthetic long. Now what happened there, this is why it got a little confusing, is when the market started coming back, I covered the long aspect of the calls for the long call. Sorry. I got to get this all straight. I have so many Disney trades. I got to figure this out. And I had it figured out on paper right before we went into this. So I did the synthetic longs at 145 plus the $3. So I'm long at 148. Those puts obviously got put to me because that was done in the November contract. Sorry, the April contract. So this is the April contract. I did it back in, sorry, I'm walking myself through this, in December. So the April contract, the 145 short puts there got put to me. So I'm long at 148. But what I had done then is gone in during that time and sold the January 160 calls for 50 cents, rolled those out to the February 160 calls, collected another 89 cents. All right, and then I bought back the February 160 calls for 16 cents when we started seeing that pullback. I'm doing covered calls on all this, right? So stay with it. Then again in the March, I went into the March, sold the 160 calls for 58 cents. Also had sold the March 110 puts. All right, now market continues to come off. I ended up buying back my March, and then I sold when I sold the 110 puts. I sold the 145 calls for another 58 cents. Bought back the 60 calls and those 145 calls for 60 calls for 8 cents. The March for 14 cents. So just lowering my overall cost basis, knowing that I'm getting put these stock again. So I'm long at 148. I know I'm getting long at 110 because the market's coming back. Those stock are going to get put to me at 110. Then selling the May 130 calls right there at around where my break even is, because when you have dollar cost average that, I'm long at 129, right? So I was like, I'll get out for a scratch, selling the May 130 calls for 50 cents, bought those back by rolling them into the June, got another collection for 32 cents. Now I finally covered those June today for 25 cents, which is really nothing. All in all, lowered my overall cost basis by $3.70, where I was long at 129. Now, you can see where the market is right now. Actually, I got out much better than we are. I got out at 117.74 today, but lowered my cost basis by $3.70, right? So it wasn't terrible. It wasn't my best trade ever, but what I'm trying to do here is explain, and didn't probably do a very good job, I'm sorry, but lowering our overall cost basis, I was literally had bad trades going against me. I was lowering my cost basis. I did a very good job at that. So that is what we try to do here with trading or investing is, yes, even though the market was going against me, I was dollar cost averaging, selling calls against it the whole way down. And, that helped out quite a bit rather than just kind of sitting on my hands with this trade. I was very diligent with it. So yes, I am talking about a lot of bad trades today, and I spent almost 30 minutes talking about these, but I think it's very important for you guys to understand how we go about all of this, especially in times like this where the market is really going against us. All right, and that's all I got for you guys. Check out today's webinar where we're going to be doing it on long call spread. So there's opportunity out there, right? Yes, there still is opportunity. There are stocks actually making all-time highs today. So we'll talk about how we implement that strategy in today's market commentary, in today's webinar. So go check that out at protraderstrategies.com. All right. One last thing we got to talk about really is, we talked about it a lot today, as a matter of fact. There is the possibility that when you're investing or trading, that there is the possibility you could lose some money. And I showed that today. Yes, you can lose money when you're investing. Even a guy that's been doing it for over 25 years loses money on it every once in a while, right? On some trades that they put on. What we're trying to do, though, is teach you, yes, we're all investing. We are doing that. But there is ways that we need to be mechanical. I can't specify that enough, right? I lowered my overall cost basis on my Disney trade by over $3.70. Yes, it was a loser. It was almost a $12 loser, right? From where I dollar cost averaged it. But when I take out that $3.70, I'm kind of looking at it like, hey, you know what? It was only about a $9 loser, right? So actually about an $8.25 loser. All right, so lowered my overall cost basis on all of that, staying mechanical. Can't emphasize it enough. Hopefully that gave you enough time to read over this, and that's all I got. If you can't take that, take it easy.